Hello everyone, welcome to another episode of B Grade Economics. I'm your class leader, Nate. Let's get started. So just to continue, this is going to be the first episode where we're going to talk about the $1,000 to $1 million asymmetric betting. This is our multiples plan and how we're going to get there. We obviously haven't started yet, so let's begin. So you've all heard about the concept of, or maybe we've come across one of those articles on Facebook where someone trades something like a paperclip or a pen and gets a car or a bike or something cool that none of us would ever think, oh yeah, this person got a paperclip and traded it for a car. They didn't do point A to point B. They did point A to point Z. They made multiple trades throughout. And so that's what essentially trading is exchanging items multiple times over for the best result. You do it one time and just be successful, but when it's something really big, it usually is going to take more steps than just a single trade with some insane person who would give you a car for a paperclip. What you effectively do is trade the delta for an alpha. The delta is a gap between something, and an alpha is the gain made. So imagine that there are two people, one who wants a skateboard and another one who has a skateboard and wants to sell it. But they're separated somehow, whether it's by time because that one wants it later, or space, as in they literally don't know where each other are and don't see each other. So you, the bright idea man, are essentially the middle person for this transaction. You're going to give money or goods or services to the person with the skateboard, and then they're going to give you the skateboard, and then the skateboard is going to go to the guy who wanted it, and you're going to compensate it. Now, it could be more money, but it could also be the fact that you got to use it for a period of time, so it depreciated in value, and you at least made back the same amount, or you compensated the difference. We've heard about depreciation of a car, the same concept. You got use out of it, and then you traded it to them. In many cases, when it comes to trading for investment purposes, our goal is to increase the total value of what we hold. So we're instead looking to try to trade for something from somebody who values it less at the time for somebody who values it more later. This could be a few minutes, few seconds, few hours, days, years, doesn't matter. It's a time frame, time space problem to be resolved. So first we're going to talk really briefly about the Nasdaq 100 because this is the first thing we're going to look at. Is the Nasdaq 100 is the top 100 tech stocks in the United States. You obviously are familiar with many of these companies: Apple, Microsoft, Google, Amazon, Facebook, Tesla, Nvidia, and so on. A lot of these companies are very big and everybody's familiar with the growth that they've had over time. Even if you don't pay attention to stocks, you know that these companies are worth a lot of money. And together they make the Nasdaq 100 composite. The Nasdaq 100 throughout history has grown drastically because of its technology, provides that asymmetry that we often look for in an investment where both it is speculative and dangerous, but because it's the Nasdaq 100, the top 100 stocks, you've taken a lot of that risk out by leveraging them against each other, and so that this way there's more than one egg in the basket. So if one breaks, the other ones are still there for you. And then they're also well developed. You know that these companies are the top 100, so they're already going to succeed in the long run. So they take on that growth aspect of what technology is supposed to do, which is to make more value. And so if we look at the NASDAQ over the past 2 years, we all know what happened in 2020, and the market fell. And this is the NASDAQ 100, the Invesco QQQ. It's an exchange-traded fund for the NASDAQ. So rather than buying the NASDAQ itself, you're buying a representative of it in smaller shares. So instead of the thousands of dollars it would cost in shares, I think it's around $15,000 for a NASDAQ 100. Instead, you're buying an index fund, an exchange-traded fund of the index fund. So anyways, we saw the drop in March 2020. And then in that time frame, we see this history of SoftBank Japan buying billions of dollars in NASDAQ call options. The volume declined as the supply reduced. And we saw an accumulation occur and a boom rocket off really fast. Stimulus has been implemented, and as I said, the NASDAQ has been around and it's tech stocks. And one of the things that's interesting about tech stocks is that they perform that asymmetry so well that people use them as an inflation hedge, because as long as the market is still functioning, technology is very valuable because that it's still going to provide a future for us. So people use this as a hedge against some extent to the money printing, and some because that is where some of the money flowed to begin with. So it's kind of self-cyclical. We saw some shakeouts and some fear go around throughout but ultimately it's followed in this general trend channel up, where the quantitative easing for the Nasdaq has kept the Nasdaq afloat, along with hopes and dreams of higher profits from major companies like Tesla. This is to show the M2, which is the money supply. It's the money printed and the money that is effectively a form of deposit in banks, so certified deposits in banks. The money supply is the green line, and the money supply has continuously increased, expanding over itself multiple times over the past 40 years. So from the inception of the Nasdaq 100 in 1985, we have clear evidence that it has grown continually. But here, this chart, the Nasdaq, instead of being priced in dollars, is being priced in the S&P 500. So this is how much the Nasdaq is to the top 500 stocks in the United States. There's some crossover between them, but the Nasdaq 100 is tech specific, as opposed to the S&P 500 includes any company that is a top performing company that is stationed in the United States. So it's the top 500 companies against the top 100 tech stocks. And we see that after around 1990, the Nasdaq just continuously outperformed the S&P 500. Like over the long term, no matter what, it continuously goes up, and we should expect that because it's technology, and technology improves efficiency and improves earnings. But it has some volatility. You had the dot-com boom in 2000, where it clearly outperformed the S&P 500 by a wide margin, but then it also underperformed for a period of time as it fell continuously. So even though the S&P 500 followed along with it, the Nasdaq moved drastically higher and then fell drastically faster. But overall, we're above our all-time highs, and so what we could expect here is that either we're going to come back down into a little bit more of a reasonable range, or we're going to follow with the money printing, or we're going to extend even further and we'll end up in a very big bubble that's essentially an expansion of much bigger than the dot-com boom. We don't really know at this time. And it's a risk to take on, but that's just a base general spectrum of what may be occurring here. That's not to say that money printing of M2 itself is directly inflation, but it has been a very good correlated response, and so it's worth noting that it does in fact respond to the money supply, and that is where people are treating it like it is a hedge against inflation. And so we look at the last year or so of the Nasdaq, and we see this trend like I was talking about. Now I've traced these little triangles of the trend to show the projection of some of these ups and down movements within that channel. And there's two general types of movements. These shorter ones, there's two of them you see, one in October 2020 and the other one around May 2020. And then the three big ones that we saw, June to October and November to about March and July to September. So this is introduction to some basic trading, and we'll cover all of this in multiple videos. This is just to get us started, but I essentially took these moves and replicated them forward from the 2 points that we touched on the bottom before. Now there are things to consider, like what is currently happening and what caused things like shakeouts. Currently we're seeing a sell-off in tech stocks as the law changed for information to be shared on devices. So Apple, for example, can no longer just take your information without your permission, and we've seen a 96% reduction in the amount of people authorizing their personal data to be used versus the 100% that Apple had control over. So it's clear that people didn't want to be sharing their data willy-nilly, and that has caused a little bit of a dip and some confusion. Now, I'm expecting it to continue on an upward path because no matter what, technology still improves our lives. It's just the top 100 stocks may be affected temporarily. So we're going to take a look at that and consider these risks along the way. But as you saw, the prices in the QQQ won't be going up very drastically. Percentage-wise, it's about 10 to 11% growth for what we're looking at in that projection. So how are we going to maximize that growth? Well, there's a thing called options. Now, we're jumping right off into something advanced like options trading, but I'm going to keep it super simple, and we will make more videos as we go. This is just to get started into what I think my first trade should be. We're going to look at a call option in order to, it's a contract that we're going to trade for 100 shares of the Nasdaq. Now, I'm not going to buy 100 shares of QQQ. I'm just going to buy a contract or two contracts to receive 100 if it hits the strike price that I set. But I don't have to do that. I can actually just sell the contract itself. So I know this is all confusing if you haven't done this before, but it is interesting to look at how you can leverage without borrowing money against your money to increase the total profit. But there are other risks. Like I said, time and distance are risks. There is a time decay to earnings and a level that you have to achieve in order to make this work on options. So you can't just do call options on everything and make money one day, because you'll also lose money just holding these options. They eventually decay. So if we have a call for the 31st of December, a contract that ends on the 31st of December 2021 at a 390 strike price call, the price for that option is $4.11, and that's on 100 contracts, so it's $411. Do 2 of them, and that's $822. I realize I just threw out a bunch of numbers, but you'll get more familiar as we get on to the next classes. This is just to get us started. So this is from optionprofitscalculator.com. It's a great free tool, so when we get into options, we'll use it more to talk about it. I may do a live stream just showing how to play with it. Here we see a graph provided once we entered this options contract, and you can see how it shows the decay of the price over time and the increase in percentage if you increase the dollar amounts. And so these little lines by color show you a date, and then you can set the price at the date and look at what your profit would be. Here's another version of the chart, and then I have laid out on the chart where these little black dots show us where our price would have to be in order to make 100% profit. So like I said, we're looking to double our money, which would be a 100% profit. So I marked out at what point in time what the price would have to be on the chart. This way I know what I have to hit. Now you see when you first start, it's a very high level that you have to beat, right? But as it goes on along the way, it does still climb, but it climbs much more slowly after the first few days. And that's primarily because of the premium that goes with the contract to get the opportunity to take on this extra risk that also offers extra reward. Now, I only have to move up around 8% in the Nasdaq in the next few weeks to make 100% profit. But I'm also taking a massive risk to loss, because if you look at where the blue line is that I've drawn out, the blue line shows where approximately I estimate the zero line to be, meaning if I'm along that over time, I should expect approximately zero profit, zero loss. The red line is our 50% to 60% profit loss or our loss range. So that is our cutoff for where are we going to no longer accept the risk on this trade. Now, if I go a little further along, you can see that how did I get that red line, or how did I make these estimates on the line? I used the options profit calculator, but I also looked at the general volatility of the trend before. And so I overlaid all those previous cycles, those little triangles that we had before. I copied the chart itself, and again, we'll go over how to do charting and how you're going to use these tools to maximize your profitability and analyze stocks and risk. What I did is I copied the bar charts and I laid them over. So all those previous moves, those past 5 moves, the 2 of the small triangles and the 3 of the larger triangles, we've set those bars on here, and that's what they've looked like. So I set the red line to generally indicate that that is where I want to be, and I matched it when I did it on the chart. I matched it against the where I would want my stop loss to be, as in where I'm going to stop the trade because I no longer want to take any more losses, because it can go all the way down to 0. If it continuously falls, or I could make even more massive losses if it makes a drastic fall. So my stop loss will continuously grow with the trade, and that will allow me to protect myself while I wait for this opportunity to hit. You can tell that the better chance and likelihood is probably going to be in this range up towards late December and late November. And so with that, this is the general syllabus that we'll be talking about along the way, the episodes I want to do to help get you familiarized. And I know that it's a lot that I talked about. And so these are all just a diving board point to jump off into for the next discussions. So episode 3 will be introduction to major asset classes. Episode 4 will be market capitalization and introduction to comparative value. Episode 5 will be introduction to rudimentary technical analysis of the lines that we talked about and how to make assessments of price movements, and then broad spectrum risk analysis. This is a very basic introduction to risk analysis, just trying to figure out where's the likelihood of something going, what's occurring, and then how do I block myself from taking on too much risk, or how do I compensate for it with other assets. And so upcoming ideas, we'll look at single options trading, options hedging, a spot position, long and short positions, stop losses trading, savings and investment. I realize that we went over a lot of advanced information that most of you have probably not familiarized with, but that's okay because that's the whole point. This is a class to get familiarized. I'm not a teacher. I'm not a financial advisor. I'm just here to talk about interesting things and ways to learn together. So again, you can follow me on Covey.io. This is my profile where we'll follow a actively managed account, and so we can just kind of see. I can kind of test like, can I beat the S&P 500? How do I manage a long-term fund with macro investments? Good luck on your trading. Enjoy climbing this mountain with me, and I will see you all next time.